after the budgets have been set, balances decreased significantly. That's mostly down to capital program delivery, and that happened at a pace much faster than anticipated, which is, in itself a good news story because that's program delivery, but it meant that the cash balances were significantly lower at the end of the year than were anticipated at the time of budget setting. In addition to that, the yield that we assumed within the interest rate environment at the time was 4.5%, and obviously that eventuated to be quite different on the payable side. So we delayed borrowing in the first sort of 2 quarters of the year, which meant that our cash balances were significantly lower than the assumed balance. But it meant that we got the favourable outturn on the borrowing costs, despite the borrowing costs being higher than we assumed in the budget. And that was kind of looking at this not from a 1-year position, chasing the outturn on this specific year's budget, but actually the medium term and the impact of borrowing externally versus using internal borrowing. And so with all that on balance, I think it's actually quite a good outcome relatively. I know it's quite a way off the mark from where we assumed things were at in that December, but the environment that we were operating in changed so significantly and so quickly that actually to manage the medium term borrowing implications of the program, I think that was the focus, and that is the outcome that we've achieved. There's a new table in here which you won't have seen, but that is down to some new borrowing that we took in year. 113 million.
Just tell us which table that is.
So this is at paragraph 5.6, and it's headed loans taken during 2023-24. So we sort of knew that we had a need to borrow, and we were following market rates and the PWLB very carefully to look for as favourable borrowing opportunities as we could throughout the year. And so we were kind of watching that daily, and when rates were, it was very volatile through a period of time, that when rates were lower than they had been in the preceding weeks, we took a small tranche, and we took multiple tranches. And I had spoken about that through previous meetings, where our borrowing strategy was to spread it across multiple different tranches to give ourselves the maximum opportunity of getting the best rate that we can. So you can sort of see that and how that's played out in that table. And then finally, just to touch on the VNS fund, the Royal London Fund, that the value of that for the council has increased by 3.24% in the year. So as we've discussed in previous meetings, the expectation is at the tail end of the interest rate cycle, you start to see an increase in the underlying value of the fund, and the yield to maturity and the distribution yield as well is gradually increasing. And there's another new chart here which we've incorporated at paragraph 9.5, which is there to try and show the performance of our money market funds and fixed income deposits against SONIA rate, the base rate, and against the bond fund over the duration of the year. And you can see actually that the distribution yield on that fund is gradually increasing, and it's keeping pace, although lagging behind slightly. That hopefully that demonstrates how at the tail end the lag works in reverse, and you have higher distribution yields coming out of the fund when our money market funds yield is dropping. So with that section, I've touched on kind of everything that I wanted to highlight. I'll just open some questions there. We'll pass over to the colleagues.
Okay. I have some questions from Liz, but is any Tara? Please.
I've got one question on page 21. Which is talking about the capital financing requirement, the approved limits and the actual debt. It looks like the actual debt is more than the approved limit, but back with that we haven't exceeded anything. So I wonder whether it was a typo.
Yes, it's sort of a typo. I sort of realised after this was published that the table is a bit misleading in that sense. So we have approved limits for some of these indicators, which we have to stick by and report a breach on. The capital financing requirement is actually an estimate of what it will be. And then the actual is the kind of outturn of it. And that basically depends on, again, what happens in the capital program and the delivery of that, and any growth in the program in future years. So that one's not a limit as such, it's a guideline. And certainly I'll amend the table to show that much more clearly.
Thank you.
I have a question from Liz. Para 4.4. If loans are so large and investments so small, how come the interest receivable is so much bigger than payable?
Loans are so small.
If loans are so large and investments so small, how come interest receivable is so much bigger than payable? Does that make sense to you?
I think that it does. So the answer to it does. I can see that. So first of all, we have a different weighted average interest rate on the loan book and a different weighted average yield on the investment portfolio, although the portfolio is obviously a lot smaller than that. And so the question is, how can it possibly be, therefore, that you're generating a high number? That basically comes down to the internal borrowing recharge from the HRA. So that's at about 130 million, which makes a contribution to the interest receivable outturn as well. So you've got the yield on the market investments, as well as the bond fund, but then there's also a recharge that comes in from the HRA to essentially compensate the council for the use of its reserves. Does that answer?
Yes. Yeah. Any other questions from the committee?
I had a question. Was a penultimate table on page 18 above. So it's the variable net asset fund as at 31st of March. The investment grade bonds at minus 3.93%. Let's talk about that.
Yeah, I'll touch on that very briefly. But that is what you and Andrew are going to talk about. But that is since inception. That's the capital return. We've tried to separate out the value of the NAV, the net asset value, and then the income as well, and to sort of show what the distribution yield is versus the capital appreciation in this case. But also worth mentioning that that's an improvement on the previous year, which was negative 6.4%. So the fund has increased in value in the NAV by 3.2%. So it is showing that sort of upward trend back towards.
Yes, it's still not overtaken, but yes.
It hasn't, no. But I think that really is down to very unfortunate timing in which we went into the fund. And actually the fund as a whole on a 1 year basis has performed much better than 3.24%. This is just relative to the Kensington and Chelsea specifically. And I think, well, I'll let Andrew and you talk to that a little bit more, and they can give a bit more detail on that. You're happy with that?
We'll just ask 5.3, the new Whitland Public Works Loan Board raised 0.6%. Have we utilised that yet?
Yes.
We have.
Yeah, we have. So, as I mentioned, there's a large internal borrowing amount within the HRA.
So then when you look at the loans taken, which show EIP profile,
Yes.
which I assume isn't it would say Public Loans Board, wouldn't it? Sorry. Why didn't we take those from the Public Loans Board?
These are all Public Works Loan Board loans.
So why are they so much higher?
But they're
0.6%.
There's the sort of profile of the different structure of the loan. EIP is actually equal installment of principal. We chose that because it's the sort of cheapest form of borrowing, because you're paying back principal periodically, so you're paying interest on a lower amount, and you have an opportunity to refinance at each point. Those are cheaper than the equivalent general fund borrowing that we took at the same time. When we took each tranche of borrowing, we took some in the general fund and some in the HRA. And so the HRA is a 40 basis point. The new special HRA rate is 40 basis point discount to the certainty rate. So certainty rate is gilts.
So what you're saying is 0.6% below what you would be getting. I didn't get the 4% as opposed to the 0.6% below that's mentioned in the paper.
Yeah, so the sort of borrowing rate that generally applies to public sector bodies is prevailing gilt rate on the day plus 1%, 100 basis points. When you opt in to provide certain information, you can access the certainty rate. So that's gilts plus 80. And then when you're borrowing specifically for delivery within the HRA, you can access it at gilts plus 40, which is a 60 basis point discount to your certainty rate. And it's further 60 from your prevailing rate, and then a further 40 from your certainty rate. So you'll note that in the various tranches that we took, there's a better rate with the HRA tranches.
Yeah, another one from Liz here. Why 6.5? Why doesn't the expenditure in 6.5 match 6.2?
Why does the expenditure not match?
Was expenditure in 6.5 match 6.2?
The difference will be down to what they're showing. So one is the impact on.
Are they measuring different things?
6.5 is the capital financing requirement.
Yeah.
Whereas $6.2 is your capital expenditure and financing.
Maybe have a look at that while you and Andrew are talking. And see if you can.
Yes.
And then finally, 8.7. And it's just a very simple question there. Why keep the VNAV fund as it doesn't appear to be doing well as compared with the MMF? Essentially, why keep it? It's not performing well.
Yeah, so it's very much a case of looking at the investment portfolio as a whole and understanding the motivation for investing in the VNAV fund from the outset, which was as a diversifier with a medium-term outlook. In a lower interest rate environment, it has a greater opportunity to take duration and therefore generate a higher yield. And that was absolutely the intention when we first invested in that fund. We hold on to it now because we do take a medium-term view, and at the tail end of that, it should go back to generating a greater yield than our money market funds, which are starting to drop off in their yield now. They generally have a 3-month sort of lag in coming up to their yield and then dropping off, and that lag won't match exactly with the B-Note fund.
So it's over time, isn't it? How these things adjust over time.
Yes, exactly right.
Okay. Any other questions?
I have just one.
There.
Thank you. I was wondering on page 13, the internal borrowing recharge, is that something which is a statutory requirement, or is there leeway there for the council to decide?
There's leeway for the council to decide, yes, and that comes down to policy as well on how you want to assist your HRA. So yes, certainly scope, and the way that it's dealt with here is slightly different to Westminster, is slightly different to Hammersmith and Fulham.
And would you say that we were the best council in that regard for residents?
I would say that KNC definitely takes an approach that supports the HRA, which in turn, of course, supports housing, and that is a good thing for council delivery. So I couldn't tell you it's the best, but I do think that it's a good.
I've just got to appeal the audit committee's foreign night to Hammersmith and Fulham.
Thank you.
Okay, so
Yes, one very quick question. 8.2, in terms of strategy, page 17, bullet point 2. Just wanted a question about how much we've got to work with other local authorities, if anything.
Nothing at the moment. That's not to say that we wouldn't. It's just that managing the cash flow, we know that we're going to need to borrow. We're not looking to lock in for anything too long.
should we move over to you and Andrew now?
Yes.
Thanks very much.
Who's going to speak first?
So we provided a short-ish slide deck. It should be familiar to those who've seen it, I think, on 3 occasions now, maybe even 4 occasions down online. Normally, I would start with an introduction about the fund and your size of investment and the high-level performance, and then we would tell you more about the team and how the fund is constructed. But can I take that as common knowledge about the fund and how it does, and then we can talk more about why it's performed the way it has.
And the impacts of that, I guess.
Sure. Okay. So we'll skip a number of pages after I introduce. So it's the Royal London Investment Grade short dated credit fund in an income distributing share class. So this fund distributes income on a quarterly basis. The figures we're using are to the end of June 2024, so they might be slightly different to what you've read in your reports now, but it's the most up to date that we can provide. So to the end of June, the portfolio had a valuation of your holding in the portfolio, a valuation of 23.2 million, and we totaled the last 4 quarterly distributions, and they're coming in at just over £1 million. So on an income distribution yield alone, the last 12 months has generated just shy of about 4.5% income distribution. So that might tally up to some of the figures which Patrick mentioned earlier. To skip past the preamble of Royal London Asset Management, we'll move to, I think, slide 11. And between slide 11 and 12, slide 11 is showing the performance of the fund. So this is over the specific time periods, as you can see, denoted by the bar charts. So the purple bar is the fund performance gross of fees, and the teal bar is the index. And the index in this instance is the Bank of America Merrill Lynch 1 to 5 year sterling non-gilt index. So the objective of the fund, we're looking to provide a total return over a 3 to 5 year medium term investment horizon. And that 1 to 5 year index is most appropriate for attempting to outperform that objective. Over the 1 year period to the end of June 2024, the fund has performed at 10.9% versus the index of 9%. As you can see, over 3 years, 5 years, and since inception periods, thankfully on this time around they've come to present to you, they are all in positive territory. The since inception figures are the fund inception. So that is from when the fund was launched, which was the 7th of December 2015. So that will give you some peace of mind that over the entirety of the fund, we have been able to deliver positive total returns over all those periods. On to slide 12. While there's a lot of colours going on here, we've separated funds performance from an income perspective and from a capital perspective. They are in groups of 3. So first would be the fund performance, the second bar will be the benchmark, and the third bar is the cash benchmark. And we can use that as a comparator tool and relay back to one of those questions around why VNAVs or why should we be in money market funds instead. And the answers to those might have changed over the last 3 years. We're going to explain why now. So the 1 year and 3 years are during that time that you've been invested. The 5 year performance is linked more to the fund itself, but the final 3 bars are the since inception of your investments. So your investments commenced on the 22nd of November 2021. And although we don't have the exact number dotted on the chart, that figure is about 2.74% total return. So that small diamond shape on the fund bar and the since inception, that is your total return on an annualized basis since that point. I'll hand over to Ewan to delve a bit deeper into the income and capital splits and why we see them on both sides of the bar.
So just on the 2.74 return, is that good, mediocre, or on an industry average?
So just to be clear, Isaac, you're talking about the size of the income bar in that case?
Yeah.
2.74. So that's the teal portion, the 2.74% of income. And I think when you make any measurement against the industry, there's a number of different measurements you can do, but the easiest one, if you like, is to measure yourself against the market index, which is precisely what we've done. So on an income basis, our teal bar is larger than the teal bar for the index. So our portfolio is generating a higher rate of income than the wider market. Also, on a capital basis, even though our orange bar is negative, so is that of the market. Our orange bar is slightly less negative. Overall, therefore, we generated a total performance since year inception, annualized, of 0.8% per annum versus a market performance total of 0. So we're precisely at the point where the market has recovered from the volatility that was mainly seen in 2022 in the year after you invested. To put some colour on that, I looked earlier to check that the market actually generated a performance, and your fund generated a performance of in the period from your inception to the end of September 2022. Some of us remember what was going on then. Minus 12.2% in that just over 1 year period. Since then, there's been a recovery back to where we are right now. The market has recovered to bring itself right back to 0, and we've recovered slightly more to bring the portfolio into positive territory. That's a long time to spend getting nowhere, but that's what happened with the market. Yields rose dramatically, and because the portfolio had interest rate sensitivity or duration, it performed negatively. And it's simply a matter of doing the arithmetic. that leads you to the capital impact of the situation. Fortunately, income is there to help. It's always there. You notice that the teal bars are always, you're always getting a positive income. It's just the extent to which they're positive that can drive you to invest the portfolio in one way or another.
That's also a follow-on question, Kevin. In terms of investment grade, short dated credit fund, in terms of quartile, in terms of benchmark performance on other funds in the market,
Yes,
which I think Chairman alluded to, are we top quartile, are we bottom quartile, are we median? Where are we with reference to other funds that have the same credit outlook in the marketplace, rather than just an arbitrary benchmark?
sure. And that is indeed the other way of measuring is versus peer groups, let's call them. And this fund is in a peer group of other credit funds.
So are they in this presentation? Those other
No,
credit funds?
no, we haven't. But we could.
Yes.
But there might be something in the bottom. No, it's just. I think I can say pretty safely that if you were to measure the fund versus its narrow peer group, and by narrow peer group, I mean that the broad peer group is other credit funds. But there's all sorts of things in there. There's ones that invest in some investment grade bonds, as well as investment grade. There's ones that are all maturities and long maturities. And what we try and do is create a sort of a carve out almost of relevant competitors. And in that relevant competitor environment, the fund, I would very confidently say, is top quartile. We have other funds that are in the same peer group. They have different restrictions on them. They have less restrictions, essentially. They're able to invest outside of investment grade only. And that's actually been to their benefit, particularly in the recovery period. It was to their detriment, I must say, in that initial period of negative performance, where because credit spreads were widening as well, and we were taking more credit risk in those other funds, they were performing less well. This fund, being relatively conservative, was a little bit better off or less worse off. Overall, however, this fund is fared fairly well, still coming out of top quartile within that narrow peer group over this inception period. But we can follow up.
It's always useful to have those comparisons, isn't it? Then just see how our investments are doing in relation.
Yeah, sure.
Good, thank you.
I mean, presumably this indicates that in hindsight, Ron wasn't diversifying the portfolio, would have done best just keeping in cash.
Yes, that's absolutely the point of those final three bars.
Yeah.
Absolutely.
But that's not the point.
But there you were in a low interest rate environment. In that period over which I described the fund performance was minus 12%. That period to the end of September 22. The cash performance, Sonia, generated 0.7%. That's all. So it's not like you were missing out percentage points worth of performance. And then we come to the more recent period, the 1 year period, for example, that brings us bang up to date. Over 1 year, we've generated a good amount of income, 4.9%. I think that figure was mentioned earlier. So on top of that, we've generated a capital performance of 6%. Now, how you might simply look at the fund in terms of where it is now and what you're likely to experience in the near-term future. The way I like to do it is to sort of say, well, what is the income rate that we're getting on the fund, and what is the likely capital increase that we're likely to get in the fund? And if you flip over the page, before I go back to the attribution of the excess performance, there's a slide 14 with a lot of figures on it, but at the top section on the left, a few key numbers there. The current distribution yield of the fund is 4.8% versus the index wider market 3.6%. So the fund is spinning off more income than the wider market can. And we're doing that by investing in bonds that are generating higher coupons and at lower prices. So the running yield is simply the coupon rate averaged over the portfolio divided by the clean price of the bonds on average. The clean price is the price of a bond, excluding the accrued income that's due to be paid on it. It's a calculation you can do for every bond and then just weight it. And it comes out to 4.8%. So that's your starting point, and we expect to get that over the near term future. Things can change over time, so you can't look too far ahead. I conservatively, I like to look a year ahead at least. So imagine that's your starting point. The average price of the bonds in the portfolio is 97.5p or thereabouts. So you're looking at another 2.5p to be delivered on every pound, so 2.5% over the average life of the portfolio, which is equal to the duration of the portfolio, which is currently 2.6 years. So the way I like to think about it is that over that time, represented by the duration of the portfolio, I would expect the portfolio to generate, so long as yields don't move around wildly, the sum of those two numbers, 4.8 plus 2.5. Now, over the last year, the reason why we've got to a number of 6% capital increase is because we may well have had some price in our favour. So the price of the bonds was maybe going from 96p up to where it is now, but yields also fell. It's because of the duration of the portfolio and the inverse to what happened in that first year of the life of the fund. The inverse has happened over the last year. Yields have fallen, prices have risen, and that's giving you that extra performance to the capital part of the performance equation. And it's been a fairly good outcome. We've ended up with an outperformance of 2% versus the wider market index. Now, the way that 2% is broken down is what's illustrated on slide 13. So a number of different dimensions of return that you can consider. And this isn't the only way of doing it, but it's a fairly straightforward way that we do it. We look at the following. We look at broad asset allocation. So rather than investing in credit, could we have invested in something else like cash or government bonds? We didn't really invest in anything else apart from credit. We're completely invested in the asset class. So we got nothing from that. Interest rates and duration. We take very small positions in this portfolio in duration, just a little bit here and there. If we think that yields are falling, and we'd rather be on the long side, but more interest rate sensitivity than the wide market, so be slightly long versus the benchmark index, we call it. We'd rather be absolutely flat, to be honest, but it's difficult to maintain the portfolio dead on flat. So we think yields are going down. Generally, we're slightly long. It was the other way, we were slightly short. We generated a tiny little bit. To be honest, it doesn't really interest us, that part. We just want to not be on the wrong side of it. Interest rate curve, that's part and parcel of deciding what your overall duration should be. You might end up being slightly more weighted to a certain part of the maturity spectrum of the portfolio. And because the yield curve doesn't move in a nice, regular, uniform up and down way, it tilts, it wiggles around. We sometimes get a little bit of a plus or a minus, but it's not very much at all. The principal ways that we generate return from the fund is to invest in sectors that we like, and within those sectors, the stocks that we like. So we'd be underweight the supranationals sector, which is a very government-like set of bonds within the wider market. They have a weighting of about 30% of the market. They're not gilts. You wouldn't really call them corporates either, but they are non-gilt credit. And the reason people use this index, we use it, is because if you're an investor who's investing, they want to invest across the whole bond market, they'll have a manager who invests in government bonds and they'll have a manager who invests in everything else, non-government bonds. And if, as I say, a fair chunk of that market is actually these supranational bonds. So they're issued by the likes of the European Investment Bank, the World Bank, various overseas multi-regional banks like KfW. It's a big, long German name that I can't even pronounce. And they happen to issue in sterling. So they're in the sterling non-gilt index. And we underweight that sector of the market completely. Not always the right thing to do. So in that early year, the life of your investment in this fund, actually those bonds outperformed. That was part of the underperformance experience that we had. But in the following period, those bonds have underperformed, as we would expect them to do. They generate a very small amount or rate of income, and they're very government-like. They don't generally produce a very high return. You wouldn't expect them to because they're very low risk of default. So we have no interest in them really. We do, however, like players such as banks and insurance companies, and also some more interesting sectors such as structured bonds. Banks are banks, insurance companies are insurance companies, but within them you can choose where you want to be invested. They have orders of seniority within their capital structure, and you can invest in the most senior, or you can invest in less senior bonds or subordinated bonds. And you have to make a balanced decision when you're investing in those subordinated bonds. On the face of it, you're taking slightly more risk, but getting sometimes a lot more return in the form of a higher coupon for taking that risk. The principal risk that we see investing in bank bonds is a risk of the bank going bankrupt and needing to be bailed out. And actually, if a bank gets into a bailout situation, everyone's invited. Doesn't matter whether you're senior, doesn't matter whether you're subordinated, everyone's invited. So on that risk return potential balance, we actually see a lot of very good opportunities for investing in bonds, which are just as likely to be bailed in as your senior counterparts. But you're getting a higher coupon, a higher return on the face of it. So, you know,
what slide will we be on here to track that? Yeah.
So that decision,
we're still on 14.
We're still on 14. Well, we're still on 13 actually. Great. That last bar there is what you get from deciding to invest principally in subordinated financial and insurance bonds. It adds quite heavily to the return that's generated.
Good.
But presumably that's something for the investment side on the appetite of that, sorry.
It's the policy of the fund. It's for the portfolio manager to decide on how they allocate risk in the portfolio.
Right, because that's for you guys really, but so our investment committee just decides how much it gets put into your fund.
Yes, on the knowledge
They
that we're
really
investing
do that.
only in investment grade bonds only.
But they could be subordination.
Yes. Subordination is not the same as sub-investment grade, just to be clear.
Sydney.
Quick question on portfolio. Thank you for the comments.
Just slide 14.
And the second bullet down, third bullet down, financial services. So of course the market, the 20s or 40s, is quite a heavily overweight position.
Mm-hmm.
But my question is on structured and on social housing, because of course some social housing we have it here in the borough, you can't re-let it to anybody else after the social housing. It's only very heavily constraints. And if I look at the overweight position that you take on the social housing and the structures, those are very, very significant index. We just walk us through strategies for those.
The thing that is common to both of those and a few other sectors is that they're all within what we bracket here as asset-backed security. So when we invest in a bond, we know we're taking credit risk, but we'd like to have something to fall back on if the bond were to default, if the borrower was somebody's unable to keep up the coupon payments. Now, as a creditor, you expect get something back anyway. Being a creditor in a company is better than being an equity holder. An equity holder, they own the problem. There's nothing left. They get nothing. As a creditor, you divvy up the proceeds of the sale of things. However, if you're a secured creditor, that puts you in an even better position. There may well be assets or predefined cash flows that are for your benefit in the situation of a default. Now, sometimes those assets can be really quite complicated. It's not simply a building that's sitting there with a value on it. It may be a portfolio of loans to have bought a number of buildings that have a value on them. And a number of our social housing bonds are like that. Within structured, again, it's not as simple as maybe just any single asset. Some are, but even if they were, you've still got to model and stress test what might happen to the value of that single asset, depending on what economies and markets might do. You've got to be comfortable with the outcome. Or they could be horrendously complicated, such as in the case of my favourite one is income contingent student loans. It's a student loan bond, but it's secured on a portfolio of loans. So hundreds of thousands of students with varying probabilities of being paid back over particular lengths of time, depending on how those students fare in the job market and depending on how the economy does in the future. And in order to come to a decision as to whether to invest in that bond in the first place, we had to undertake some fairly significant supercomputing time just to get to the point of making that decision. And the fact is that many investors are put off even considering those kind of bonds because it's hard. You might not get to the right answer. Where that leaves us sometimes is that those bonds are staying there, very attractive potentially, in that they have security to offer, but very attractively priced as well, because they've been left on the table and not poopered up. So there's opportunity.
So just picking one example, if I look at slide 15 and I see the Westfield Stratfield structured bond, that would imply the asset that we all know is Westfield, and there's some sort of structured paper on that instrument. But I come back to the social housing. The council may not be able to sell the asset social housing. They may not be able to get people in there to pay. So there would be a higher risk, which is why the index rating for social housing is very low at 0.6, where we've got 2.3. And so I'm just asking the question as to whether that's the right blend, specifically within construction social housing. Because I can understand Westfield was actually the largest shopping centre in Europe, but social housing has a lot of restrictions, and we have social housing within.
Sure.
So I want to hear a bit of detail.
So I think it depends on the individual wording within the language of the bond agreement. So when you sign up to lend money to a social housing borrower, it very much depends what that borrowing is on the basis of and what it's secured by. Is it a set of simple assets? Is it a set of loans? What the recourse is to local or even central government protection for a bondholder, what the covenants are around it. Everyone is different. You may well be familiar with, some of your own. Very likely, that's very different to lots of other things out there that we can look at. And we can say to ourselves, well, actually, if we think that all we're left with is an asset that may be difficult to sell, that's not necessarily what we want to be invested in, unless the price is extremely attractive. Now, the curious thing is, the credit rating may be fairly moderate to low, reflecting the high probability of default on the bond. But the mitigation is the quality of the asset itself and the price together with the price that you've been asked to pay for it. So I wouldn't say that we don't care about the possibility of default of an asset, but we're not preoccupied by that alone. Rather, we're interested in whether we're going to be repaid our money at the end of the life of the bond, or even before the life of the bond if it defaults. and we rely upon the security being of a sufficient value to give us a good outcome, that security has to be liquid enough for us to be comfortable buying that bond in the first place. Liquid enough.
Yeah, I'm slightly conscious of time while we're on this. Did you have a very quick question, Joanna?
Yes, I just wanted to ask about fees and other charges, and where we're sitting in terms of the portion of growth and real fees being going up.
The fees on the fund itself are fixed at 0.24% per annum. They are accounted for within the daily unit price of the fund. We define the fee as the fund management fee, FMF, and about 4 years ago, 4 or 5 years ago now, we took the decision to move away from the majority of the market to split an annual management charge and ongoing charges figure. So an AMC and an OCF, sorry for banding around the acronyms. But in that case, the fund would have looked like 0.2% annual management charge plus what can be a variable ongoing charges figure. And so we fixed that on the average ongoing charge over a 12-month, the prior 12-month period. And that's fixed for, we define the medium term. And since that point, there have been no suggestions of fees going any higher. And funds that were under question 4 or 5 years ago have actually come down in fee. So that is a completely transparent, or as best we can possibly be transparent about the fee that you are being charged. What we don't do is keep a running tally of the fee that comes out, so we could best estimate to you based on the number of units that you own, the market value on a daily basis, and multiply that by 1/365th of 0.24%. But if everybody asked to do that, we'd have to hire a new department to keep running tabs. But that is the best way for us to be transparent and say, regardless of whatever fees are going on within the fund, from accounting to legal to transaction, etc., that is what you pay.
You'd like to send that, Patrick?
There's quite competitive fees relative to assets in the pension fund universe. Generally, it's fixed income, so it should be relatively low, but yeah, I think it's reasonable.
Okay, Patrick, do you any? I'm conscious of time on the agenda. Patrick, any final comments you'd like to make?
I think, can I come back to you on the question of 6.5? I think it's down to that being the net capital expenditure, so it's net of financing and the implication that has on the CFR, and that's why it doesn't match up to the table 6.2 of total capital expenditure. But I'll provide a more detailed explanation at the next committee, I think. That's okay.
Thank you. Tara, any final question or words of wisdom for us on this?
I don't have any further final questions. It was just the one I mentioned earlier. It's also reviewed by the investment committee here of the council of this, or with the appetite for how much we put in this fund, for example, how much we weight our investment in that compared to other things, money market funds and everything.
Yes, it's ultimately that's a delegated decision within the treasury management strategy. So Mike would make that decision, and it would have to be within the context of the specific investment strategy at the time. The cash balances are not sufficient enough to consider that at the moment, to be honest. But the kind of inception of this, the way it came about was, as you said, a very low interest rate environment, and there was a member's push to generate a higher yield, and so the officers were tasked with finding a way to do that, and so taking a longer duration than within 12 months was certainly a way to do that.
But Tara, that was.
I was just slightly wondering, is it this committee or is it the investment committee that decides on sort of appetite or risk appetite and
It's the investment committee.
Yeah.
the investment strategy, they determine that, do they?
Do you mean by the pension fund investment committee?
I think
Yeah,
it's
just
the
about
pension
treasury.
fund committee decides the pension, but that's not listed in the accountants.
The treasury.
Functions, there's the
Yeah,
pension
it's separate.
and the executive director of resources for the.
The investment committee is just about that.
Oh, it's only about pension,
Yeah.
so the treasury strategy, the risk appetite for the treasury,
Yes.
and the investment strategy you just mentioned,
Yes.
within which Mike makes decisions.
Yeah.
Who decides that?
So we take the treasury management strategy statement to full council, and full
Right.
council decides that.
Okay.
Yeah. And there'll be input from Johnny on that.
The lead member for finance.
Okay.
Yeah.
Fine.
So there is a democratic oversight as to
Yeah,
this.
that's what I'm saying.
Yeah.
Okay, so I'm going to bring this to a close now. I think we've given it a good airing, and thank you for the three of you for being here. So in terms of committees asked to review and comment, we've done that. So that's our information as a report. So thank you very much indeed. Thank you. Can we now move on, please, to item number 5? Draft statement of accounts. Item number 5 is the draft statement of accounts, which was published on the council's website on the 31st of May. These accounts are presently being audited and are subject to change as a result of the audit. The committee is asked to note the draft accounts, and could I ask Lisa, the Director of Financial Management, and her colleagues to present the report to the committee. And just for the committee, remember these are still being audited, so we may have questions on them, but they're very much a work in progress. Lisa, do you want to?
Yeah, thank you, Chair. So as the Chair says, these are the draft accounts for the financial year that ended on the 31st of March 2024. Covers the previous 12 months. The audit is taking place at the moment. I'm pleased to say that we have no earlier audits outstanding. So we are up to date, and we are hoping that these accounts will be presented back to you at the September meeting, and we will be able to complete the audit by the statutory deadline, which is the end of September 2024. As you know and have seen, and we had a pre-meeting earlier to brief the accounts are a very big document. There's lots of detail in there. It looks at the council general fund, it looks at the pension fund, there's an HRA in there as well. So there's a lot of technical information in there. The auditors will go through that in a lot of detail, and they are already. They're asking a number of questions of the team. And we will bring back in September the final accounts following their review and feedback from the auditors who will attend the September meeting. We haven't gotten here today because it would have been fair. They're in the process of their work at the moment. So I'll open it up for any questions that the committee may have.
Any initial questions? I've got some from Liz. Would anybody like to? Yes.
I had a quick question on the capitalisation direction. Give us an update and brief.
So we completed the capitalisation request from Deluxe. So if you remember, we requested for 75 million pounds, and we have been awarded up to 75 million pounds over a period of time, and we have. Share over there. Thank you. So it's detailed in here in the accounts, but we provision was created in 21-22 for 41 million pounds, and that was made up. We funded that at the time because we didn't have the capitalisation direction from 2 reserves. Now we've got the direction over the years 22-23 and 23-24. We had the capitalisation direction in 22-23, 23 million, and then we had the balance up to 75 million in the year just finished. So in 22-23, we repaid for the reserves the 23 million, and drew down the capitalisation direction. And then this year just finished, we repaid the remainder of 18 million. That does mean we've still got a balance left on the capitalisation direction at the moment because we've only drawn down 49 million of the set up to 75 million. And we will only draw down what we need to, we may never hit full 75 million. And that was what was keeping the accounts open previously with the auditors, but they have been able to finish their accounts and their work on that. I'm just going to look to my colleagues who are closely involved in that as well, if I've missed something. Thank you.
On page 42, big page 42, again, we're getting confused with page numbers here. The big page number 42, and this ties in with it. So we've managed, haven't we, to
Page 14.
so on page 42 at the top, it's just really just looking forward, we have been able to help ourselves, if you like, by short-term reduction in employees' pension contribution. That clearly is a one-off. What happens to that funding and that once we stop being able to do supporting it by short-term reduction in the pension fund?
Yeah, so we've used that saving from the pension fund to repay the capitalisation direction at that point in time. We are hoping by the time the money that we set aside from the reduction in the pension fund contribution has been all utilised, that we would have reached some resolution and we'll have some other monies to pay back the capitalisation direction. I can't say too much about it at the moment because there are processes in place, but we have
But that's not expected to go on for 2 or 3 years, and it is genuinely a one-off.
It's a one-off from or a couple of years, as we heard earlier, from the pension fund savings, and that should cover a couple of years of borrowing, and then it should have a different way of sorting itself out after that.
Okay, thank you.
Thank you.
John?
It pops up in a number of places. The accumulated absence reserve. I don't understand how it works. Does it get lost? Do you pay people out and then take holiday? What?
No, it's an accounting sort of entry. You don't actually pay people, but we are required to account for any leave that's not taken at the end of March, so that or employees, so that if everybody left at the end of March, how much would you have to pay them? And for that reason, we do an accounting entry. We calculate how much, we work out how much leave people have left, work out how much that would be in money terms. And then we put an entry in the account. So that is offset in the reserves, there's the unusable reserve. Yes, it's offset there.
So first of all, if I have 25 days and I've used 20, or I've used only 19, can I carry forward 5? And are you valuing 6 that I haven't taken? You're only carrying 5.
We only do.
And then at what stage does it drop out? At any stage, or does this cumulative reserves fund just keep growing?
No, so every year we work out at the end of that year how much leave has been carried forward up to the allowed limit. So if it's 5, I think during COVID we were allowed to carry forward up 13 days or whatever. So I think last year we were only allowed to carry forward 5. So we work out how much that is in money terms. And then the next year what we'll do is we'll say how much leave has been left. We will reverse out the previous year's values and we just only account for what is belonging to the year that's in question. So whatever leave is carried forward at the end of 31st of March, based on how much you're allowed to, it's a maximum 5 or less. That is how much we.
If you're reversing something out, it goes back into usable reserves.
No. The entry is literally between creditors and with unusable reserves. It's just a plus and a minus in the balance sheet on 2 sides. That's it.
Can I also ask about page 79, the officers' remuneration? I got somewhat confused. And Andrew Burton, who's only been in post since June, and he's on an interim basis, just seemed very high. Is that accurate?
Page 70, big page 79.
He's an agency worker, so that is accurate.
And he's still in place.
He is still at the council at the moment, yes.
79.
Sorry, it's page 51.
Yeah, we're running on 2 page numbers here. So yes, Andrew Burton is currently the interim director of transport and regulatory services.
Okay, thank you. And then just one other thing, external audit costs, so page 54, large, 82. If you can use rise, and I know we've probably done on this deck with a committee, I think it might be helpful to have a note to explain why, to people who don't know, why the audit costs shot up to 441,000 as opposed to 239 last year. And again, I know it would be helpful about the re-procurement of the audit contract and hence the difference this year. It's a different reason.
We can add a note to the bottom of note 21 there, in the advice accounts, yes.
Okay, I have a couple of questions from Liz here. 6 point, page 31, where is the budget stabilization reserve? And I think that's small page 31. There's a list of different funds, and her question is,
It would be general fund.
where is the budget stabilization reserve?
Number 5.
Yes, so it's in the general fund on page 31, but if you go to page 34, it's broken down and you can see budget stabilisation reserve and so
Just say that last bit again, please.
on page 34,
Yeah.
the reserves are broken down, so you will see the budget stabilisation was different ultimately.
Okay, that's fine. What else do I have? Page 41, and I suspect that's small 41. Cannot tie table into accounts, nor tables on pages 42 and 43.
Sorry, can you say that again?
Yeah. So page 41, which is probably small page 41, either report. Cannot tie table into accounts, nor tables on 42 and 43.
Is that the figures?
So page 30 of the accounts, the narrative report that shows you the position for each of the spending departments at the council. You can see is that report at the top in that table, the departmental spends, the revised budget extending the outturn, and she was saying she couldn't tie it into which page?
Pages 42 and 43.
Really, it's capital, so that's
The 43 capital, so the table on page 13, which is page 41 is revenue, and the following page is capital, so we're looking at 2 completely different things in there.
and 14 is HRA, so
Yeah.
that's all separate.
So the 3 tables are all looking at different elements.
Different aspects, yeah. Okay. Any more questions from the committee members? Claire?
Quick one, thank you. On page 13, in the narrative report, which is page 41.
Yeah.
Where we are looking at future rental support, I'm seeing figure of 355 outturn. Yeah, and I'm wondering, since I don't think that's yet being implemented, what is that number related to?
So that was spent in the year against that cost centre. If you want more detail, we'll have to take that away and come back to you if that's okay.
Thank you.
We're happy to do that.
I've got a question on the pension side.
Yeah.
Page 107 of the report. the very top of the page, look about the average age of active members based on the 2022 valuations, 53 years and 64 years for the London pension fund. When you looked at that in 2019, it was 46 years and 61.
Joanna, hang on a minute. I mean, are you?
Sorry, I think this is more for junior public.
Yeah.
Anyway, because I think that the answer to the question is that in terms of the numbers that you're seeing there, they're all the demographic assumptions that are used by the actuary. So they will be used across, so we use Hyman's Robinson, for example. That's not numbers that we come up with, that's from their data resources. So they use something called data beta, I think it is. So that's something that we use with all the LGPS funds, and that's why it's not a decision down to us of those increases. So that'll be things that's happened within the last year. It could be, as an update to whatever. I think they have done some sort of recent updates with their actual data on the back end of the data, and things feeding into that could have been from COVID or ongoing issues that are going on.
Okay. So you don't think there's any great significance to attach to any of those changes in your assumptions?
No.
Yeah.
I was just going to say, I think London Pension Fund Authorities is a predecessor fund, isn't it? So people will be old in that fund and they would be
Yeah, there will be.
So the difference between two funds, nothing else is very much about current membership and it's historic fund.
Yeah, okay.
Sorry.
So just on the pension fund, I presume it's not really for us to decide, but you've got 7 professional investment managers, and I presume that that's something the investment committee will decide on, and also that the overall decision to have your own pension fund rather than share pension funds, to kind of get economy of scale.
So in terms of the managers, that is something that's looked at each investment committee. So we have investment strategy. We have an investment advisor to attend each of the meetings where we review the investment managers. And what was the second part of the question?
Well, it's just that actually the overall question, which must have been taken ages ago, to kind of decide to have your, RBKC have its own pension fund rather than have a shared one, and possibly going to get economies of scale by kind of combining with other. I know there's some element of shared.
There's a lot of history to that. It is a decision made quite a long time ago, and actually there's 86 pension funds across the country, and that was down from a larger number at a previous point in time as well. However, the economies of scale question is very much part of the pooling agenda. So the London Collective Investment Vehicle is the London pool. That's the pool that all of the London funds are an owner of, a shareholder of, and invest in to certain products to try and achieve that economies of scale. So where the product exists that's suitable for the investment strategy, funds will opt into that.
Sounds good.
KNC doesn't invest in any assets within the pool at the moment, but it's also the most well-funded fund in the country. So
a message we keep on hearing, which is good. So just a general. Sorry.
So this is one other area. We did talk about the annual governance statement, which is quite an important bit. There's obviously rightly identified principle. I think rightly identified the Oracle implementation, because I know there seems to be really complicated, which is a lot more complicated than you can think. I just wonder whether you can just kind of pause for a moment just to think, have we got everything, with, for example, deterioration in kind of general funding as opposed to kind of costly services. We have other things raising here. So obviously we've managed it this year, but I just wonder whether that was something we want to kind of raise either at this meeting or at subsequent meeting.
David, do you want to make any comment on that?
Yeah, so the Oracle implementation, as it says here, going live in April 2025, there's a very well structured approach to that. I'm the senior responsible officer, Mike Curtis is the sponsor, David is on the strategy board as well, and with other colleagues. So we're keeping a very close eye on that. And yes, you're right, like any of these projects, there is a risk involved. But we're keeping a close eye on that, which is why it's in the annual governance statement. So Grenfell again, absolutely, it'd be very remiss of us not to put something so so enormous as that tragedy into this. We will keep an eye on the budget. Obviously, we're going through a savings and transformation process at the moment. There was a report, leadership team, an overview and scrutiny committee. There was the MTFS leadership team, and then overview and scrutiny last week had a savings and transformation report as well. I think this is all looking at 23-24 accounts, but it's something we're looking forward to make sure that we continue to deliver balanced budgets. We talked about it earlier around reserves and making sure we've got adequate levels of reserves as we go forward. So certainly something we will keep a close eye on. And I think as time moves on, particularly next year, you'll see more reference to savings and transformation programs.
That's what.
It might be useful at some stage for us to have a briefing on the new system, because that is very complex. And there's a whole lot of risk associated with it. And without being too judgmental, we haven't been very successful in the past with certain big schemes. So I think we as a committee would need to get abreast of that.
So we committed to take updates to overview and scrutiny committee, so we can bring the same update here in the future as well.
Good. Sydney,
Just a quick question. Page 91. And this is in relation to self-insured assets. So paragraph 2. Big 91, small 63. Big 91, small 63. Second paragraph from the top.
Yeah.
See, the council self-insures assets valued below 250,000. So my question is twofold. What's the total amount that we self-insure for the assets that are valued at less than 250,000? And how do we reflect all of the self-insured assets within the whole council in the accounts?
So I can take the first question away in terms of what the value of assets that we self-insured below £250,000 is. And the second question was what's
the value of all the assets within the council we self-insure?
Okay.
And where are they reflected in the accounts? And what I'm getting to is, if we self-insure £50 million worth of assets, how do we reflect those in the accounts?
Yes, we can take that.
I understand where they fit. It's fine.
I mean, self-insurance is very much a mechanism by which you assess the risk on individual assets and the cost of insuring down to zero. So again, as we tender into the insurance contracts every 5 years, we take a risk-based approach. I'm happy to take that away to the point.
Interesting enough, OSC is looking at council insurance strategy so that we can understand it.
good. Could I just ask a more general question on pensions, please? So you've got a big number, page 159. And I guess it's, going forward and looking at our pension funds, if we think that people may be retiring earlier and maybe living longer, we're very proud now of our pension fund at the moment, but go forward medium to longer term, are we going to need to change contributions? How's that fund going to look going forward?
Yeah, Devin, it's a very good question. Longevity was a hot topic a little while ago, actually, and there was the assumption that everyone was going to live longer and longer and longer, and that was going to put a lot of pressure on pension funds generally if it's a defined benefit scheme. That longevity trend plateaued off a little bit, actually, and that has sort of stabilized. So that's not to say that it can't tick up again and people generally live longer. So that is all factored in the actuarial valuations and the data that Julia alluded to, the club visa, life expectancy, average age, all of that is a huge set of data that will be constantly refreshed. And it is, whilst it's a large pool of data, they can take elements of it and apply it to the area that you're in. I think the example that they often give is maybe it's Kensington and Chelsea versus Glasgow, and there's huge differences in the life expectancy, so they do reflect that in their actuarial evaluations as well. But absolutely, that's why we can't look at each valuation in isolation and say, well, we're overfunded by 90%. Let's stop paying contributions completely, because we actually do need to take a very long-term view, because it's an open-ended fund. The youngest member might have just joined and then they've got their whole working career ahead of them. So we are always looking to invest in a way that generates growth on the assets. But whilst we are so well funded, the strategy does reflect that as well, and it tries to match liabilities that are defined by the valuation process in terms of cash flows, and the index-linked gilts in the portfolio help to do that too. The property investments within the portfolio are very much designed to generate cash flows in order to aid in the payment of pensions, whilst still having a large allocation to equities, which is your growth asset within that. And it is also why the conversation happens every 3 years on what the appropriate contribution rate is, and it's why we try and keep primary contribution rates stable. That gives budget certainty for the underlying bodies within the fund, but sometimes we'll adjust the secondary rate, which is where the savings come for the general fund, and that wasn't even for the duration of the 3 years. Very much recognizing that they've tried contribution holidays in the past, and it really got the funding levels all messed up for a lot of pension funds. So we are generally a lot more cautious in how we approach contribution rates. But certainly the outlook is, in theory, forever, whilst it's a closed-ended, an open-ended fund.
Okay, thank you. So the basis that this is going to come back as an audited set of accounts. Any final quick questions? And we're on time, aren't we? We're not going to get. I know you can't say this for certain. We're not going to get Grant Thornton coming back and saying we need to delay our September meeting.
So at the moment, they are, as Shona said earlier, they started a couple of weeks early. They're working through. It's really hard to say, because if they find something that causes them a problem or a delay, we won't know until they find it. But we are in regular contact with them daily, and we have proper catch-ups with them once a week. So if there's anything flagged, as soon as we know, we'll make a judgment call on that September committee. But I'm pushing them, and I'll say this, I'm pushing them hard and fast to make sure that they do try and hit that deadline for us, because it is really important.
So we've got a couple of things we need to follow up on from the various questions.
Yes.
But thanks to the team for, again, the way you manage this process, the way you get the accounts in early, and the way that the accounts are presented. So thank you to you, and thank you, Sheena.
Sheena needs to take all the credit.
Yeah.
The pensions team here.
And you. So thank you, folks, for being here tonight, and thank you for the work you do in getting these together. And we look forward to a positive audit outcome in September.
Thank you.
Thank you very much. Thank you. Can we now move on, please, to item number 6, data protection performance report. So, item 6, the data protection report sets out how the counties complying with GDPR and the Data Protection Act of 2018. So, Fatima, you're going to introduce the paper for us, please.
Yes. So this paper is for information purposes. It doesn't go into granular details, primarily because that's not the purposes. It's just to give them an update on how the council is doing with regards to those protections in general. And so the report really just sets out some key areas within the council, which from a compliance point of view are quite key in terms of demonstrating our performance in this area. So I haven't chosen everything I could have. I've chosen those things that I think are key, demonstrating to the community, but also to the ICO, should they become lucky. But this is, we've got our structure in place. So having said that, in terms of the background, we know that the Data Protection Act came into force in 2018. It changed the goalposts, it changed the way in which data protection was viewed by the regulator, by the government, by basically saying you have to evidence what your compliance looks like. You can no longer just simply assert, yes, you're complying. So as a result, we had to put in place structures to enable us to evidence what we do. With respect to that, so we've come on, so part of our data protection policy is to try and really set out as a council what are our enablers, how are we responding to data protection requirements. And so, for example, I've listed here some of the things that we've had to put in place or build upon in terms of capacity. Because it would not be true to say they weren't in place before, but not in the way that they are now. So, for example, we have a dedicated data protection team, and they're operational. They really manage a lot of our data protection compliance around the rights of the individuals, subject access requests. So this team is quite central to our compliance strategy. Similarly, we also work with cybersecurity and information security resources. So we're kind of all linked, and we work together in a collaboration to achieve compliance under the GDPR, because I think sometimes what people forget, which is understandable, but the GDPR is the compliance framework for all secure information security, cyber security. If it goes wrong, it doesn't go wrong under any other statute, it goes wrong under this one. So the accountabilities are linked in that way. Let's see, sorry. Then we've got so other things that we've done, obviously, we've got social care. It's very important for us that we are managed compliance on social care. Echoes of Grenfell are there as well. What we've done is the council actually has a corporate guardian board made up of adults and children and public health, and they review on a regular and robust basis, I would say, anything around data protection, processing, client data, security, etc. So that's quite key to our strategy as well. We also are lucky to have a list of like nominated officers throughout the council. They work, that's primarily organised by the data protection team. It's got a long history to it, but basically it's nominating people throughout the council, throughout the services, who can then feed back requirements around data protection issues to those service areas, team leaders, etc. Like that. We've got that. We also have to do things for our staff. It's, data protection is also not just about servicing our clients, but also protecting our staff. So things we try and do there is ensure that there's the right guidance is available to them. So we've got a dedicated intranet site for that. We also do things like we monitor compliance rights quite closely, so we're complying. On the training and risk awareness, this has always been slightly problematic for all organisations, I would say, not just us, all organisations, but we're making good progress. We've introduced a new refresher course, which takes some of the pain out of the original course that you have to do when you join. And we've seen an improvement there in terms of participation. So we've gone up from a compliance rate of 50% last year, 50% of staff have done the course within 12 months. And now we've seen to date, we're seeing that rise to 73.5%. So the refresher course has had a positive impact, I think. Similarly, we have taken seriously data protection risks, and from a pragmatic point of view, it's important that we try and understand, think about data protection risk in everything we do, because ultimately we're functioning, working with people's information, and there's a certain level of trust about that. And we need to ensure that all the systems we procure, all the projects we pull together, etc., do consider data protection, because actually it is at the heart of what we do. It might be disguised in various ways in terms of buying a solution, but if the solution doesn't comply with data protection, then there is a problem. So, for example, what we've done is we've got this, there's a tool called the Data Protection Impact Assessment Tool, which is basically a risk tool. It's saying to all our agents, and that's our third-party contractors, as well as staff, have you thought about the data protection aspect of what you want to do? Is there any, risks that are jumping out at you that you didn't consider, or maybe you now need to consider? And what I'm really pleased about in the last few years is that process has become quite embedded in our procurement process. So everything we do around procurement, we think about systems, projects, people, whatever we do, data protection considerations come into play there. That's quite an achievement, I think, personally, that we as a council have managed to get through. Prior to that, it was almost like, as you know, it was like, well, at the end, last minute, when people thought about data protection, which gave it the bad reputation of saying no. In fact, it's not about that at all. Coming through the report, so I'm pleased about the training that's improved. I'm pleased about the risk assessment, the awareness of it, that's improved. And in terms of subject access requests, where people have a right to request their information that's held by the council, since the GDPR came in, and since we've had figures going back in 2022, 23, we've seen a real rise. In the number of requests. And these, what they're noticing here is they are complex requests. They're not just simply, I'm going to give you a photocopy of your information. Your information might extend 4, 5, or 6 volumes, depending on your relationship with the council. There will be issues around exemptions. And part of what we do is we have to review everything before we send it out, so that we are not inadvertently unauthorized disclosure. And so for those figures, to see 300 and 300 and up that figure is very high. It's very high. I can't tell the benchmark if other councils are experiencing. I suspect they are, but people I know amongst my colleagues and other local authorities. So that's quite resource intensive as an activity. And of course, people also make assumptions about what the council holds about them, which 9 times out of 10 is not to be the case. So there isn't this kind of coordinated big brother oversight of all the information. It doesn't work like that, but that's partly why these things have become more complex. Erasure, we initially thought with the GDPR that the introducing a right to erasure that information deleted about an individual was going to be problematic. But we managed it because we had a very good verification process. So saying, prove that you are entitled, that you are this person and you're entitled to this information. But on top of which, the very fact of what we do means that to date we've not had to comply with an erasure request, because we're a creature of statute. We have to evidence what we do. We cannot delete the evidence because someone's not happy with us. So we managed to, in that sense, we will affect the right if it's viable and if it's not subject to any exemptions. But to date, we haven't had to do that. Do we get them in? Yes. And I would say what's coming through is these companies who've developed on the back of the GDPR coming in 2018, where they basically offered to coordinate erasure requests for individuals, but then kind of back away from providing the actual evidence that they are entitled to the information. So we do see quite a lot of those.
So is that a paid for service? So if I had wanted my details,
No, it's free.
so no, but why would I get a company to step in and ask?
I don't know, to be honest, because you could ask directly the council, but for some people, they use an app. They're scrolling through there and they get an app and they download it and they get a company to do it for them. I have no idea why they do this, because it is easier actually just to come to any organisation and say, give me my data.
They're sharing their details with a third company.
It's weird, it is weird, but that's what, there was that trend. In terms of performance, we're not doing balanced subject access requests, which is the main thing we would be measured on by the ICO. And as I said, we looking at these, what I've put in the report is that the ICO set organisations a rough benchmark, 86% answered within their statutory time frame. And I'm really happy to report that at the moment we haven't dropped or 92%. So, yeah, it's a fantastic show by the team.
As Fatima says, complexity of records is a thing, particularly in social care. So children's social care records go back 75 years. Yeah. So imagine the subject access request for data that goes back that far. It's very complex in terms of
it can take 2-3 weeks to read.
Yes.
Because then we have to analyse it, we have to apply the exemptions available. So it's not an easy task, and they've done really well in bringing up the figure.
Good, well, thank you.
That's it. I think there's incident managers. I will say one thing. We do encourage staff to report any incident, i.e. anything that breaches or could breach data protection act in respect of people's information being mishandled in whatever description. And that's something that we still need to embed further across the organisation. That's down to us in terms of raising awareness. But I'm happy to report that of the times when I've had to give it to the ICO, to report to the ICO, which is not many, as you can see on the figures here for our BKC, we've had very few that are reportable to the ICO. And of those, we've had no comeback from the ICO, no further action, no fines, no directions on how we should be managing data. So I'm really pleased with that as well.
Well, thank you for that, Fatima. What size team have you got?
I don't have a team.
Yeah, it's you.
No. I'm the statutory data protection officer. You have to have one of me by law. And then we've created that. We've always had a data protection team who are separate to me. So they don't report to me.
Right.
Because I have to have a level of neutrality in the information advice. So I can't be someone who processes personal data. But I work very closely with them and act as their consultant as well.
So let me rephrase that question. How big is the data team?
They're about 5 strong.
Quite intensive work, isn't it, when it comes in?
Because they also are the FOI team.
Right, so FOI is on top of this.
Yeah, so they do the data protection, they provide data protection and operational support, and they also do the FOI requests coming in, and they use the case management system.
And do you know off the top of your head how many FOIs we get a year?
Roughly 2,000.
Oh gosh, so
and that's been steady over the period of time. In a different life, I managed the FOI. I know it's roughly around.
Any questions?
Very quick question. Thank you very for the report on page 180, paragraph 4.1. There's 2 things. The compliance rate at 73.5% staff. Yeah, I've asked this before. Is there any sanction on the other staff who aren't complying with cyber training that they obviously need to do?
It's difficult because it is a mandatory requirement, but the enforcement of it is difficult, shall we say. So it's about nurturing staff awareness and raising them to actually do the records, do the training. So, and as I said, that and also making the training easier because every year you're doing the same training. So what we've done is in our BKC is introduced a shorter refresher course, and that has really helped people get on board with it.
In the private sector, if I don't do my mandatory training, I can't log into the computer, so I can't actually do the work in the private sector. Yeah. So I just asked that question. The second part I made, Chairman, is as we're getting a new IT system brought in, has anything been done to work with the training that will be done for the new system so that we can be one step ahead of the curve, so when the new system is in, we'll have new training.
That's a good question. So I think it helps to in part to answer your first question, Councillor Anderson. So we have some issues with recording a completion of training on the current IBC system. So we're probably under-reporting compliance a bit here. The Oracle system will actually help us with this to manage it more effectively, to chase and promote training. Digital data and technology the team have been helping directors to chase staff who haven't completed training as well. So I think that's been another reason for the uptake. But I think the new solution, the new system, the Oracle system, will help us get a better grip on reporting and data who has and hasn't. I think there are still some conversations to be had, as you say, about making sure enforcing why people can't log on until they complete
But like
training.
managers,
Performance
management, and we can say problem actually at the department.
Yeah.
Very, difficulties in people to comply, but.
Yeah.
And I think we've got a solution, but I would agree with Councillor Yanson that, it seems mad that it's so voluntary really when it's actually mandatory.
Yeah. Yeah. And I guess a lot of that lies with the managers as well. Those managers, how they position and how they.
But the new system will enable the managers to have better surveillance over compliance around the issue. So they'll be able to better see how many their staff are completed and when.
Good.
Are you seeing the other 27%? Is there a department that stands out? Is there a level of staff that stands out?
Can I answer yes or no to that?
I can do what the law says. I can neither confirm nor deny.
Perhaps a different route by the chief executive.
So, Beth, you said quite rightly with this report, you sometimes I'm pleased that, I'm pleased that, I'm pleased that. What do you give me one thing you're less pleased at in terms of the way we as a council handle this? If there's one concern.
I think I would like to see more. We've always survived on data protection with very limited budgets. We basically budget for the staff and a case management system. I would like to see the introduction of a better monitoring system across the council that would enable us to answer all these deeper questions around things like compliance, things around complaints. I'd like to see them have a budget to actually bring in something bespoke it to the end. The other thing is for me, I think seeing senior managers lead from the front would also help significantly, because if you don't have their backing for the best reasons in the world, but if they're not visibly backing this requirement, then again it tends to fall to the lower echelons of life who do have concerns. Because as I said, one of the things that we are charged to do as an organisation is to safeguard our staff. And they do have concerns sometimes when they're asked to process information in particular ways and they don't feel comfortable with it. I'd like to see more senior management involvement.
Well, thank you for that. And thank you. Sorry, Claire.
Sorry, I just have one quick one, which is partly just a point to raise, I think. All of the statutory obligations under GDPR, which apply to staff, I am correct, am I, in thinking that they also apply to members?
They do. They do indeed, because I don't know if I can't remember how many years been training with me in the past, but basically members have 3 or 4 different hats. Depending on how you look at it under the GDPR, you act as individuals in private capacity. You can act as party political reps, and you would act as administrative reps for the council. And for your constituents, you are data controllers, in your own right. So it depends. So if you have a breach with council data, then it's for the council as data controller to manage. If you're having it as an individual constituency rep, then it's for you to manage. You can come and see as advice, obviously. But so that's
thank you for that. Yes. And sort of related to that, I wanted to ask, I'm not sure which of you this question will go to, but I was wondering about the Cabinet Office Defending Democracy initiative around cyber security. Would that also come under your remit?
So that's something, again, prior to the elections, since going back in December 23 from the Cabinet Office, didn't it? So training was provided for members and for senior individuals in the organisation who may be at a heightened risk of exposure to cyber attack. So again, we've seen through the elections, there's not been anything we've seen through DVNT where that's occurred. I think it's important to keep that message going in terms of the high profile of key individuals, both members and officers in the organisation.
I think that was extended to all members, wasn't it?
Yes, it was. Yes,
as
it was.
And members do have their own portal that includes their actions. And I believe there is training directed for members. There's those pastors.
It's on the portal.
Yes.
Thank you very much.
Good, thank you.
Thank you, Chair.
And thank you again for this report, and thank you for being with us this evening. So I'd ask the committee to note this report. Thank you very much. Thank you. So let's move on to item number 7, work performance and action tracker. And there's a couple of updates on this, I think.
Yes, Chair, particularly around 178 and 179. Hopefully, the committee received from Yusuf last week the note on the audit fee and the sort of arrangements if the council wish to give its own external auditor.
Yeah. So any other observations on that action tracker, please?
I wonder about on the notes, there has been a briefing. We had a briefing on the procurement. Oh, actually.
Sorry, sorry. That's
175. Sorry, 175. Yeah. So that's,
no, I'm just about to complete that to go out to the chairs of screening committee, so I will send it to the committee as well.
could I ask a question?
Chairs as well. Happy to do that.
Any other comments on that?
I think it seems to be shorter than it used to be.
We have reduced it quite a lot.
Yeah, I'm really pleased to see that.
I'm grateful to Yusuf and Lisa and other colleagues who helped with that.
And also everything that's green will be removed going forward.
It will, yes. So each time the green drop off, drop down and drop off. Yeah, that's it.
The only thing that isn't on here that I just wondered whether it's been closely closed on literally was the fire doors issue. So I remember having had it in the past, and it's concerned the accidents was the fairly time. I know it doesn't seem to be on this list. Does that mean it's solved or it doesn't make the cut? Or?
No, so what we will do when we come back to the next audit updates later in the year, we can include a section on that. So I think we'll talk about how you do that like through the risk management or the audit updates. See what that yeah. That's not been lost. So yeah.
Good, thank you. We now turn to the forward programme. Do members have any comments in relation to the forward programme? We will obviously the September meeting. And always invite members that if you want things to be included in the agenda that you don't see on there, I think me or yourself a call and we can look at where it fits in.
So, Mr. Chairman, I'm just intrigued that the last meeting is 23rd of June next year, when this is almost the 22nd of July. So is that intentional that it's not 30? I'm pleased it is. I'm just intrigued. But will the draft reports be available by then?
But there'll be a meeting for July as well.
Right.
We always have one meeting for the unions set for this next year.
Thank you.
Yeah, if we roll forward, it will be there.
I was keen to drop
Good, thank you very much. In that case then, this concludes the meeting. No more items on the agenda. This concludes the meeting. The next meeting of the Audit and Transparency Committee will take place at 6:30 p.m. on Monday, the 23rd of September, 2024. Thank you for everybody for your time and the people who come to present to us this evening. Thank you. Chair, thank you.
Okay.